and only those who were really patient and waited benefited massively because a lot of the gains were towards the end of the bull market. Am I saying we're near the end of the bull market? I don't know, because things are so different today. That's the other thing. The fundamentals are so warped against the currencies. There's so much debt. Saturday, March 30th, 2024, Maneco 64, home of alternative economics and contrarian views. So we're going to look at gold and silver today, our favorite metals, monetary metals. And I think silver doesn't have long to catch up with gold. And we're going to look at history to try to ascertain when silver will eventually free itself and start going a lot higher. And I think once it catches up with gold, it will overtake gold and outperform gold. Does that mean you should get rid of your gold and get silver? It's up to you. Me personally, I just try to hold on to everything I've got and maybe add on to my silver, maybe add on precious metals miners, like silver miners. That's more speculative, of course. That's up to you to decide and to do your homework. I wanted to apologize if you hear a funny noise. Rudy, he has just jumped off the sofa and he's chewing his Yonks bar, which is like a metal milk chew that lasts for Yonks. So yeah, he might jump back up on the sofa, who knows. But one thing I would say, though, before we start looking at gold and silver, is that this is just more than like a secular bull market. It's much more important. And why is that? Well, because gold and silver ultimately are money. And what the collapse of the fiat currencies versus gold and silver is telling us is that there's trouble ahead in terms of the purchasing power of our currencies. And that has everything to do with the cost of living. And yes, gold and silver, they forecast what people call inflation, even though it's actually the consequence of inflation when you inflate the currency by creating more currency pieces. Gold and silver get the signal first because they are the other side of the currency. Some people don't know that. They think people like me and others who say that are crazy, but they need to do their homework and realize that gold and silver were there before promissory notes, and nothing's changed. Why do the banks still keep gold? Why do the bullion banks still keep gold? Why do the central banks still keep gold? Because they would be naked if they didn't have any. And the problem with the bullion banks as well is that they use the gold from the central banks. They lease it to get liquidity. The problem is when the gold price and the silver price start going up, they're in trouble because they have to cover their shorts. And I think that's what we're seeing. But that's a different topic. But as I was saying, usually when this kind of bull market in precious metals happens, the people who have the foresight to get into it, like we have, they are ostracized. They're called hoarders. They're called speculators. Even though we're just protecting ourselves financially. So that's what I would say. And many of you might say, well, they might come after our gold and silver. Anything's possible, but before they do, it's still the best place to be, I would say. So enough of that talk. Let's look at the charts and why I think silver has, it doesn't have that long until it catches up with gold. And what I'm going to do here is look back to the 1970s at some charts. And I have to thank barchart.com. It's a good service. So I'm going to start with the gold price. And it's a monthly chart from 1970 to just before we went up to almost 900. And I'm going to show you another chart later on, much longer term, and you'll see the whole bigger picture of things. But as you can see, gold, of course, was fixed at $35 under the Bretton Woods system. And then in August of 1971, Nixon had to let the system go, close the gold window. And mainly because the gold price in London was already testing and breaking above that 35 level. As you can see here, in August of 1971, we're already trading up to 44.25. But anyway, we went from basically 35 all the way to 195.50 in December of 1974. So that was kind of the first leg up in the bull market in gold. And then it corrected almost lost 50% of its value, gold, and it traded down to 102.20 according to bar chart in August of 1976. And I'm sure there were a lot of people back then who probably were disgusted with what gold did. But if you look at it longer term, it was still way above that $35 level. So what I'm trying to say here, a lot of people probably got out. They were frustrated. They thought gold was going to go straight up to 1,000 in 1975. And therein lies a bit of psychology for us, a bit of what I think is really necessary, patience, because what I've learned since 2002 when I started buying a little bit of gold is that the market will do what it does. It doesn't do what you want it to do. Yes, back in '08, I thought the financial world was going to end and gold was going to go to the moon. And it did go higher, but you need to be patient. And I think that's the whole lesson of being a stacker. And basically, being in this trade, it is a trade. And Jesse Livermore said, if you think you're right, you got to sit tight. That's where you'll do well. And this is a funny trade because it's not a security. It's not a stock or a bond. It's money. But the reason it's become a trade is because our monetary system's so screwed up. So it becomes like a trade. But anyway, what I'm trying to show you here is that, it wasn't until December 1978 that gold really started taking off and broke back above that 195 level. It had done that back in October of 78, but it corrected back down. I wonder if a lot of people got out of that as well when we got back below the 75 low. But then, in December 78, it finally traded back above 200. It closed at 226, and then we never looked back. We never went back below 200. So it was around December, January that gold really started taking off again. And the reason I'm showing this is because now we're going to look at silver in the same period. And as you can see here, silver used to trade just below $2, as you can see, in the early 70s. And then in February of 1974. So that as well was a little earlier than gold in 74, because gold topped towards the end of 74, and silver topped in February of 74 at $6.70. And it wasn't until, really, if you look here, February 1979 that it finally broke above the February 74 high. So it took 5 years, and it was a month or two after gold. So if we look at gold now, we're really breaking out, of course, and it's in the month of March. I would say there's not long to go until silver starts catching up with gold. It could be April, could be May, but we're very near there. It does give us a bit of time, actually, to load up. Am I telling you to do that? No. That's my opinion. That's what I think. But if you are looking to load up and you want to help the channel, yeah, think about using our affiliates. All the details are below in the description. Let's look at the bigger picture now, long-term charts. So I wanted to show you here, looking at the 70s, that it wasn't plain sailing for gold and silver. A lot of people think, well, gold and silver did really well in the 70s, but it was a frustrating market, just like it's now, as you can see. And only those who were really patient and waited benefited massively, because a lot of the gains were towards the end of the bull market. Am I saying we're near the end of the bull market? I don't know, because things are so different today. That's the other thing. The fundamentals are so warped against the currencies. There's so much debt. Back in the 80s, early 80s, late 70s, the national debt to GDP was only 35%. We didn't have the huge derivatives market that we have today in the quadrillions. There was no such thing as financial derivatives. Maybe a bit of currency futures, but all the derivatives were more in the agricultural commodities in general. So we've got another chart here, and this is the gold chart. It's a linear one because it's easier for you to see what I want to show you. A logarithmic one is a bit more smooth, so you won't be able to see it as well. But as you can see here, that 70s action created like a teacup, and we broke through there, of course, towards the end of 1978 in gold, and then it was pretty much a straight line to January 1980, when I think the high was around 887. That's what Jim Sinclair always used to say, 887.50. Bar chart has a high of 850. But anyway, and then we move forward to the mid-90s, to the early 2000s, and we formed another one of these teacups, and we broke out of it. And then the market went almost straight up, almost up in a straight line, except for the correction in 2008, where we traded back below 1,000, and even below 700 briefly. We got to 685. But it's becoming, it's looking more and more like a blip. And of course, a lot of people at the time probably got out of gold. They thought it wouldn't go any further. They were frustrated, maybe. I remember that really well. The premiums were really high when that happened. And then all of a sudden it just shot up to just above 1900. So yeah, that was basically the result of breaking that teacup from the mid-90s to around 2004 and 5. So gold went from basically 400 to almost 2000 in a straight line. It took, of course, yeah, it took a few years. It wasn't as fast as the 2000 or the 1970s move. And the other thing as well, they were all moves of about 8 times. So in 1975, gold bottom around 102, and we went up to almost 900. So that's a bit more than 8 times, and the same thing in the 2000s. We bottomed around $252, and we went up to above 1900. That's just under 8 times. So what about now? Well, we've got another teacup, which is really deep, and finally we're breaking out of the teacup, as you can see. And one might say, isn't there going to be another test of that 1900 high? Just like in 2008, we retested the 1000 level again, or the 887 level, I'm sorry, again. Well, I think we've done that already. And why do I think we've done that? Well, because we broke out of that 2011 high back in August of 2020, and then we retested that 1900 back in July of 2021. We tried to break out again in March of 2022, and then we broke back down and retested, and even went way below there towards 1620, and then we tried again back in May of last year, and we broke out, and then it failed, and we came back, and we went, late last year, we went back to 1820. So we tried it 3 times already. It's failed 3 times. So what I'm trying to say, and it's always dangerous to say these things, I'm not sure we're going to go retest 1900 again. I'm not saying we're not going to have another correction eventually in gold, but I think the correction is going to come from a lot higher level. So if you use the 8 multiplier, roughly 8 times from the bottom in 75 and the bottom in 2001-2, what do you get in this current move? Well, the bottom was in late 2015 at 1045. Easy maths, right? 8 times 1045, somewhere around just above $8,000. But as I said, the fundamentals are so different these days. The system is so inundated with debt. Our political, economic, social, geopolitical world is so uncertain that we've also got all the symptoms of currency collapse. So yeah, I think it's going to get really crazy, and I think the bull market in precious metals and commodities in general, it's going to be one about fear, not greed. Why do I say that? Well, because when currencies collapse, people are fearful. They want to get out of the currency. They're not buying gold and silver because they want to make the currency. It's not from greed. I think we're going to experience fear in this in this current leg of this bull market in precious metals or bear market in currencies. And with that, I'm going to recommend a book that I think could be forecasting, so to speak. It could be give you a picture of what could happen in society when this sort of currency collapse occurs. And the book is The Mandibles by Lionel Shriver. Again, I'm going to thank one of the viewers for recommending this book over 5 years ago. And it's really interesting how things are starting to look very similar to the situation in this book. Just read here from the back. It says, it is 2029. So I think I bought this book, when was it? Should have been 2019. So it felt really far away then, 2019, but now it's only about 5 years from 2024, right? It says, the U.S. national debt has grown so enormous that it can never be repaid. The dollar is in meltdown. A bloodless international currency war will wipe out the savings of millions of American families. Their pending inheritance turned to ash. Each member of the formerly formidable Mandible family must contend first with disappointment, then the challenge of sheer survival as they navigate a society in ruin. A frightening yet scabrously funny look at a nation's not-so-distant future from the pen of perhaps the most consistently perceptive and topical author of our times. The Mandibles, a Family, 2029-2047, is Lionel Shriver at her incisive best. Yeah, I recommend this. I'm not saying it's going to happen just like in the book, but it gives you a taste of what it could be like. So with that, I'm going to wish you all a great rest of this Easter weekend. For those of you, of course, who celebrate Easter. And yeah, I'll talk to you later. Take care. Bye.